Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, November 13th, 2018. In this video, I wanted to kind of go over a few things. I wanted to do this for members of the site, and what I wanted to do is just give a quick update. What's some things that are going on with the site right now, a couple of changes we're going through, and how that may affect the subscribers who are trying to access the site. And then I wanted to roll into that sort of parlays into the trade ideas, or really the lack of trade ideas recently on the site relative to the activity in the market. And what I mean by that is um, we had, as swing traders, active traders, this is when we make money. We make money during these periods, during volatile periods, long and short. We swing these rips and dips, and that's what we've had so far. So there's been really two periods during the year, early in the year, really from kicked off in January, and so far this year kicking off in early October. And then in between, we've had some unusually long and steady periods of low volatility. This is where you make money in your 401k. This is where just sitting tight or buying the dips, that strategy works. And this is where active swing trading works, and buying the dips will get you killed, and it'll drive you crazy watching your 401k balances at night. So now, with that, a couple things have happened. I want to talk on this with the site. We've had a surge of traffic to the site, both existing members. There's some members that are active and they're in the trading room every day and they're doing what I'm doing, watching, looking for any opportunities, jumping on things, whether it's swing trades, day trades. And then you have a good percentage of people who are work other full-time jobs, or maybe they're retired but they don't want to live and breathe trading day in and day out, and so they maybe check in from time to time here, but then start becoming a little more active when the activity on the site is. And that's what you'll notice over time. Trade ideas will ebb and flow with market conditions. One thing I will tell you, and I've said this before, since I've started this site, I refuse to sacrifice quality for quantity. What I mean by that, I'm sure a lot of people think if you're, subscribing to a service, whatever it is, in this case, right side of the chart, that you want quality, you want trade ideas. How many trade ideas a week? And I refuse to work off that model. I don't think it's a good long-term model. I don't think it's good for anybody's bottom line. I can tell you, doing this many years, that I make the majority of my profits come in spurts that sometimes I have to wait for months on end. Now, it doesn't mean I won't take any trades between then, but I'm not actively trading or making a lot of profits. They come during these periods when you have these sharp moves up and down. And that is when most of the profits are made. So I've used the analogy in the past. I love watching the Animal Planet and those shows, and you watch Big Cat Diaries. They're out there in Africa, and a cheetah, or even a lion for that matter, it's not going to run after every gazelle that walks by. Why? Because if it does, if it chases every gazelle that gets near it, it's going to die. It'll expend too much energy. Its catch to kill ratio isn't, or chase to kill ratio is not that good. A lot of things get away. It will die trying. So as a trader, it's the same way. You need to sit, wait patiently, let the markets and your trade setups come to you. Um, and not try to overtrade, because I can just tell you that is a sure recipe to giving back your profits once you've had a good run like this. So with that being said, we've had a lot of traders come in, both the subscribers and especially some new people to the site since volatility has started. That has caused a low that we've never had on the server. I've spent, personally, hundreds, well over 100, couple hundred hours in the last few weeks working with developers, numerous developers, my hosting company. We got some bug fixes out, did some things that improved it. But as of today, I want to let you know we've upgraded. We're in the process of upgrading the site. I've decided to just go ahead, move to a much more powerful server. That's being migrated today. That's what caused the outages today. I was going to wait to the weekend, but I had the site go down once again today, and said no more. Let's go ahead and make this change. So pardon my dust, or our dust, please. This will be over with soon, and then hopefully we'll get back to business where you don't have any interruptions or periods where you can't access the site. So that'll be over soon. On that note, what I'm also working on with developers as well is building out a new support center for the site, a comprehensive support center, help center that answers a lot of the questions. With this surge in both existing clients coming in and new people, I am spending much too much time answering questions, a very large part of my day, replying to questions. And please don't misunderstand me. I enjoy those questions. I'm glad to answer those questions. Um, Most of those questions aren't anything I could bring on somebody to help with. Simple things like billing questions, upgrading from a silver to gold membership. But the majority of questions I get are really about the markets and trading. Hey, how do for example, how do I set up my chart? What charts do you use? I get that question. And please, you're welcome to ask it until it's there in a support center. I will have questions like that clearly laid out. Here's the charts I use. Here's how I configure this. But I must spend, 5 to 8 hours or more a week on typing the same responses on how to configure a PPO setting or how to draw a trend line, or do I use log scaling, or what charting platforms do I use. So all that's coming. Um, but with that, and once that's rolled out, I will be raising rates on the site. And I'm going to do that for two reasons. But before I get into that, let me just say this. Right side of the chart, I decided a while back to implement a lifetime rate lock guarantee. If you are a member of the site, as long as your subscription's current, your rates will never go up, no matter how high they go. So don't freak out with the rate increase. I'm doing the rate increase largely to slow the growth rate of the site down. And if it gets to a point where I have to shut down and not allow any new subscribers, that will be the next step. I'm not running this site to see how much money I can make selling subscriptions. I enjoy what I do. I love doing this. I love talking to other traders, sharing what I see. And at the point it becomes more of a job than a hobby, that's it. So I'll let you know. Of course, to protect the existing members and myself, I need to have the time to find these trade setups, to do my own trading. As well as to answer questions of members of the site. So let it be known that those rates will be going up. Hopefully to have that done by the end of the year if we don't run into the holidays and get delayed. And again, the site should be much more efficient then. You'll be able to find what you need a lot easier. And of course, I'll always be here, and I still am now, to answer any questions. I just want to ask those of you that sent some questions. I can see my inbox piling up today. I'll get back to you as soon as possible on to reply to those. All right, so that is what's going on with the site. Again, rate lock for anybody who's already a member, and I will announce it before the rates go up, so you'll have plenty of time if you're on a free trial period. And again, I just want to make sure that I don't get overwhelmed and I can focus on what's most important, finding the best looking trade setups and keeping a pulse on not just the stock market, but all things, commodities, wherever the opportunities are. That's what I am. I love to go around. I'm not pinned to trading any one type of security. If it has a ticker symbol, if I can click a few mouse clicks and buy or sell it, and I can chart it, I will trade it. And we're going to get into that in just a second here. In fact, let's roll into that now and talk about where the trading opportunities might be right now and going forward. So the question I had put to me recently was, Randy, what if the market crashes? Where do I put my money? Where can I make money? Not where can I put it, where can I make money? And my response is this, and I've said this many times to many people over the years, that there are times where you just can't, there aren't a lot of opportunities to make money. It's rare. Usually, there's an old adage on Wall Street, there's always a bull market somewhere. And that is normally the case. But I've talked about this in recent videos, how normally when stocks drop, bonds go up. And we haven't seen that. We're seeing oil crash. So the whole theme of the last video I did was this whole credit slash margin bubble bursting. I believe that's in play. I'm going to go over that today and just highlight, some examples. But for the most part, everything's dropping right now. There's not a lot going up. Gold's not, I'm talking relatively speaking. Gold's not going up. Bonds aren't going up as much as they usually do during periods of market volatility. We all know stocks aren't going up right now. Even a lot of the commodities that I was eyeing recently are getting sold off too. Oil's plummeting. So my reply to that individual was, and again, this is not individual investment advice, it's just generally speaking, most people underestimate the benefit of cash. Most people have a mindset, where can I make money? Where should I put my money right now to make money? There are periods where you just can't make a lot, but it's better to not lose than to try to risk money and force trying to make something. In other words, I always say you can't, squeeze blood from a stone or water from a rock. Well, sometimes you can't extract profits from the stock market or the financial markets, that is. So we're going to get into that now, and that's so what I'm seeing right now. The function of the trade ideas being light are a function of my focus lately, well, some of these issues on the site, but more so the fact that the stock market has been extremely conducive, the broad markets, to trading. And so therefore I've put most of my focus, my own personal energies in trading, as well as what you're seeing on the site. Trade ideas are very thin right now. I think we have, going from memory here, 3 official short trade ideas: Netflix, QQQ, and Nike. That's pretty thin right now for, relative to my outlook on the market. Longs we're in pretty much defensive type stuff: gold, GDX, treasuries, and not a whole lot there as well. But again, those are what I think are the best opportunities right now in the market. And so while we don't have a lot of trade ideas, as I said, I'm not going for quantity on the site. And if that's what you're looking for, I'm sure there's some services out there that will guarantee you 10 or 20 or X number of trade setups a week. And if it's quantity, you're going over quality, absolutely check those out. All right, so looking again at the markets, when you see swings like this, where this is SPY, you go into QQQ, which is my preferred trading proxy, you have daily swings of 4% or more in some days, from highs to lows. And you have these, periods where the QQQ or even SPY, which is much more, balanced and diversified, still dropped about 12% off the highs. I think QQQ is down about 15% almost, and then bounced back up. This is where a swing trader makes money. And when you have the indexes moving that well, you're diversified. That's another thing I like about it. If I buy Apple or I buy XYZ company, I have to worry about when they report earnings. I have to worry about if there's some kind of accounting fraud, or the CEO dies in a car crash, and the stock gap's down the next day. With a trading an index fund, you have safety in numbers: 500 stocks roughly in the SPY, in the S&P 500, about 100 stocks in the NASDAQ 100. So I don't have to check every so often for earnings. I don't have to manage a portfolio of a dozen names. Now, normally, you're not going to extract a whole lot here. Swing trading SPY and these trends here, you can trend trade it, but this is where you're going to swing trade it. Get in, get out, make 5, 8%, recycle in, make it on the long side, do it again on the short side. So I wanted to get that out there. And now going back to where to put money, we know that stocks aren't doing well. And I'm going to go over the various asset classes right now and take a look at that, and speak to really the bigger picture of what's going on. But so again, my reply to that individual was cash. A lot of people underestimate the benefit of cash. Now, I'm not saying, again, it's not individual investment advice, and you don't have to, nor would you probably want to put all of your money into cash. And when I say cash, I'm not talking dollar bills, $100 bills. I'm talking cash equivalents. Those are money market funds, savings accounts, money market accounts at a bank. A money market fund is through a broker, money market accounts at a bank, things like that, where you're going to earn minimal interest. Let's just call it nothing. Maybe it's 0.5%, maybe less, maybe a little bit more, but your money is guaranteed and safe. And if this all ties back into the recent video I did about the credit bubble bursting. Margin bubble bursting, a lot of margin calls right now. And let's just talk on that real quick. So we all know what's going on in the stock market. I don't need to really spend a lot of time there. We know stocks have been falling. Whether that correction's over or whether it has more to come, only time will tell, but it's very clear that the market has been under pretty heavy distribution in recent weeks. Any rallies get sold into pretty aggressively. That's still been the trend. I don't want to digress in this video and go off. We'll cover there's really not much to update today. SPY closed about flat. QQQ closed up 0.08 and SPY down 0.19. So really not a whole lot has changed since my outlook from yesterday. The near-term outlook remains bearish. We'll see what happens. If we happen to turn around and start moving up from here, I'll give you some updates. So all right, so we know stocks are going down. You haven't let's talk about asset allocation, then I'll cover all the asset classes here real quick. Let me I have a slide for. Okay, real quickly, just a very brief overview of asset classes. What are asset classes? For those of you not familiar, my previous life, I was a financial advisor, stockbroker, financial consultant. Did that for many years before going out to become a professional trader, trade on my own for my own account. Now, when you walk in or you do your own finances, possibly if you work with a financial advisor, you've probably heard the term asset allocation, and that's saying of your portfolio, your long-term savings or all your money. Um, you want to spread it around different asset classes. Now, what are asset classes? Well, you have stocks for one, which are, we all know what that is, Apple, Walmart. Even if you buy QQQ or SPY, you're buying the SPY is it's investing in the S&P 500. So you have 500 different stocks, and technically SPY, although it's an ETF, would count in that category of stocks because it invests into an index that holds a lot of stocks. So stocks are one asset class. We all know about that. High return potential, but also risk. In the last bear market, the S&P 500, which had your steady Eddie dividend stocks, defensive issue stocks, dropped about 55%. And that's, sometimes bear markets are a little more mild. Sometimes could be even worse. Then the next asset class you have are bonds. Again, this is a simple view. Stocks, bonds, and cash would be your three main. This I grabbed this off the internet. I didn't even look too much. It's missing the cash portfolio component. So most portfolios will have a small sliver for cash, and that's money market equivalents. That'll even count short-term CDs and things like that. So let's just say that's cash. And this one breaks it down between large cap stocks, small caps, and again, you can drill down within stocks at different sectors. Bonds, 20%. Within bonds, you also have different types. So let me get back to what I was saying here. You have three main types: stocks, bonds, and cash. All right, those are your three primary asset classes, and this is cash right here. I don't have a little typing tool, or I'd type the word cash. And then there's some alternative asset classes too that should be in a portfolio. I'm a strong believer in that. That would be commodities, real estate, precious metals, other things like that that you can still invest in, and that helps round out a portfolio. So this is a basic asset allocation model. Again, a basic asset allocation model. The general rule when I started the business back in the 90s was you take somebody's age, take the number 100 minus their age, and that's how much should be into stocks or equities. So if somebody was young, 20 years old, should have 80% of their money in stocks, 20% into other things, mostly bonds, real estate, commodities, stuff like that. And because the older you get closer to retirement, you should pare back that equity portion because you can't afford another 2008 meltdown, a bear market that wipes out 55% of your portfolio right when you retire, and then you're drawing income off it. You won't recover. That's why you shift out. So that's why these aggressive models have more stocks and more cash. But again, this works, and I went over that in detail in another video. I talked about all kinds of stuff, the efficient frontier, and how to, um, you know, uh, how you can actually reduce volatility in a portfolio and enhance returns at the same time by incorporating bonds. But as I told you, that's not working. That's what's going on in the market right now. There's a couple things. You have the financial, the unwinding of what I call what I believe to be a credit bubble. Forget about all those charts. And you also have a lot of things dropping. So here's the stock market. We all know the stock market's been dropping, right? And then we look at bonds. We look at long-term bonds, which normally go up. This is TLT. This is one of our active trades. And I went over this again in a recent video. If you didn't catch that video, I'd highly recommend it. I can't recall the title offhand. It was within the last week or two. Shoot me an email or something in the trading room, and I'll find it for you. But this is very unusual to see Treasury bonds falling in line with stocks. Normally, when you have a sharp sell-off in the market, this is the king of flight to safety instruments. This is TLT, an ETF that holds long-term Treasury bonds. And normally, when the stock market drops, TLT goes up and helps offset those losses. We're not seeing that. And again, this comes back to the recent video I did about the huge credit bubble the Fed has blown and inflated, which I believe is starting to pop and has a lot more to come. There'll be times where you'll see things come back in, and there'll be certainly rallies in Treasury bonds and certainly rallies in stocks. But again, if we have a 10-year bubble that's been blown to huge levels, it's going to take some time to unwind. And right now it's a little ugly what's going on. But this point, again, come back to what I'm trying to drive home here is there's not a lot of places to hide. So there's treasuries, which are one type of bonds. On that real quick, just want to mention that all bonds are not created equal. Essentially, what a bond is, it's a debt instrument. You're borrowing money from somebody's borrowing money from you. You buy a bond. The issuer, in this case, we're showing you treasuries. Treasuries are from the U.S. government, so we know they're going to pay back the principal. There's no question about it. If you buy an individual bond, not going to be the case with TLT. I don't want to get off topic, but individual bond is like a CD. You pick the term, there's a rate, you're going to collect the interest all throughout there. That interest rate cannot change on a fixed rate coupon, a fixed rate bond. And government bonds, because they're the highest rated, are AAA, at least at this point in time. And as you go down the spectrum here, these are corporate bonds, and corporate bond mostly, or any type of bond really. Government bonds can be knocked down off AAA. But you go down the spectrum, and the rating scale gets lower. Once you get below the triple B rating right here, that red line, they're considered junk bonds. Doesn't mean throw them in the garbage. They're still paying interest up until this point here where you get down to the triple C or D rated. D means in default. You're not getting anything. You're not going to get your interest payments while they're in default. Some bonds come out of it, and you may not get back some or even all of your principal as well. So why would people buy these? They pay a higher rate. Um, this is going to be a whole nother topic. I might have to cover this in another video. I'm right now very concerned with the middle part of this credit spectrum and the lower end. Junk bonds, the spreads have been very tight to treasuries, meaning normally you get a much higher rate when you go out to junk bonds because you're taking a lot of risk. That spread recent, until this whole correction is starting to widen again, has gone down. Most of the junk bonds out there right now, and you like an ETF JNK or LQD, which holds junk bonds, majority of those are in the energy sector. We know what just happened to oil, and the energy stocks are finally playing catch up to the downside. If oil prices stay this low or continue to go lower, you're going to see a lot of default. You're going to see junk bonds, ETFs do very poorly. I would personally stay away from junk bonds right now, especially because of what's going on in oil and the energy sector. And that's again a lot of the issuance in recent years has been from that sector. So that's going to affect JNK and LQD. So I don't see a lot of opportunity right there. And then I'm also concerned with the marginal corporate bonds that are right now investment grade, that may be bumped down to non-investment grade to junk right here. So this end of the spectrum, the triple Bs. There's a lot of triple B issuance in recent years. And what's going to happen is everything I've said so far is starting to happen, and I think it will play out. Before this market even topped, I said, or right after it was topping, my theory is everybody was looking for a reason for the next bear market and couldn't see one on the horizon. The banks are strong, stress tests, this, that, the other, they're fine, they passed, and nobody saw the reason. I think it will be that the fact that stock prices kind of collapse on themselves as the technicals play out, stocks move lower, consumer sentiment starts to decline. That is 80, 70, or about 2/3 of GDP is from consumer sentiment or consumer spending. So when that goes down, the economic outlook will go down, and I'm already seeing that now. The economic outlook the forecasts are starting to taper down. It will become a vicious cycle. If the market goes down, the more it goes down, the more they'll temper down economic growth. The Fed rate expectations will go down for the Fed rate hikes, everything else. And this is what I'm concerned. There are a lot of bonds right on the verge here of being investment grade that get bumped down to junk bonds. What does that mean? Oh, no big deal, Randy. They're still going to pay their interest. Well, wrong. What happens is everything, the whole financial system is built, everything's so intertwined. As these get bumped down from investment grade, the bond market is much larger. A lot more money in bonds and in stocks is larger than the stock market. So when there are tons of bond funds out there that have a directive, if they're investment grade funds, they can only hold investment grade bonds. So when this whole tranche or the stack of triple B bonds and lower rated bonds get knocked down as economic conditions start to slow, interest rates go up, they have a harder time servicing their debt load. As bonds come due that they already had, they have to reissue, roll over at higher rates. They get knocked down into junk status in non-investment grade. What does that mean? All of a sudden those funds have to sell them, and who's going to buy them? The buyers aren't going to want to absorb that. There's going to be a lot of movement out of there. So anyways, I wanted to go where I was going with that is so we're talking about the different types of bonds. Corporate bonds aren't looking so hot either. This is investment grade corporates. They're a little better off. Obviously, they're better off, in my opinion, than junk bonds as we head into a slowing economy. But you want to stick with the treasuries. That's why I picked TLT. You can get a higher rate on LQD. You can get even a higher rate on JNK, which is a junk bond ETF. But those I am staying away from. Junk bonds typically trade in line with the stock market, and this one could have a lot more to go on the downside. And again, investment grade corporates, well, most of the dividends are secure. However, as they get downgraded, the price of those bonds will fall. And so, where again, the whole theme here, the reason I'm talking about all this, and I know I might be talking so fast, I'm, maybe losing some people here, but I'm looking where to put money. So far I've gone down the line. Treasuries, I like as a strategic play right now. I'm not going to get married to the TLT trade, but for the near future, and it is playing out. Again, you can see, look at these charts. You see corporates dropping, you see junk bonds dropping, but yet TLT is starting to move up recently. And the chart confirms it, and so does my at least my fundamental theory. If it continues to play out, will be one of continue revisions to the downside for economic growth, which then brings down lower long-term interest rates, which then brings up the prices of the existing bonds. Remember, when rates go down, bond prices go up. On top of that, the Fed will start to, mark my words, if this continues, if this stock market continues lower from here, doesn't rally back up soon, you'll start to hear dovish, more and more dovish statements, the Fed backing off. And the reason they're going to back off, not only slower economic growth, it's this implosion of the credit bubble. So we're talking about TLT. I'm showing you asset classes falling. This is what I'm talking about. And this is deflationary here, not inflationary. And the other thing is oil. So you talk about inflation. What's one of the biggest drivers of inflation? Energy prices. Not just a barrel of oil, but it runs into everything, into energy to power your house, heat your house, or even manufacturing. Things have to be built. They take energy to build it. Planes need to fly. Fuel's their biggest cost, second biggest cost behind salaries. But there it is. This is a huge drop in crude oil prices. This is deflationary, and it shows where are you making money right now? Where are the institutions making money? We know they're not making it in stocks lately. They're certainly not making it in stocks. They're not making it in just about any type of bonds right now. They're not making it in crude oil. And I'll finish going through the list here. Crude oil is only one of several types of commodities. Let's just look at a few others here. I'm just going to run down my list. I have a commodity list below. Here's gasoline prices. Obviously, gasoline prices will track crude pretty closely. Here's cotton. Cotton's been dropping. I'm just running through commodities. I'm trying to show you the places that normally hedge funds, individuals like myself, and why we're not seeing a lot of trade ideas, where you might make money. So you're not making it in commodities, which are, or at least cotton, I should say, which is an agricultural commodity. We have sugar. Sugar was doing great. We had a trade earlier in the year. We got out of that one, but sugar has been going down recently as well. And I've been, highlighting these commodities, but not pulling the trigger again since this sugar trade for any official trades on the commodities. But what I'm seeing here is just broad-based selling in just about every single asset class, and that is unusual. Again, usually there's always a bear market somewhere, a bull market somewhere. Not seeing a bull market in many places right now, and that again comes back to the fact that if I try to throw a lot of trade ideas out there, I'm trying to force things. They're not going to play out if everything's falling. That's sugar again. Let's see. I'm just clicking on these random. Coffee. You can see coffee falling. There's wheat. Wheat prices have been falling. That's a grain ETN that holds several of the grains I just showed you. Corn holding up, but again, commodities have been in a vicious bear market, and some of those have moved off their lows, but we're just not seeing wood timber prices, wood lumber collapsing. So here it is. I'm digging. Soybeans really, near their lows. There's just not a lot moving up. This is livestock, ETN. Here's cocoa, had a little run there, but broke down recently. So I think you get the point here. Natural gas is ripping lately, but that won't last. I think that's just a fact. I think natural gas is about at the end of the run, and it's a seasonal thing. Natural gas, you can look back at a 10, 15-year chart. Usually in the wintertime, whether it's either October through December or early January, February, you have a big rip like that, and that's about it. Okay, real estate, that is another niche asset class of its own. This is a real estate ETF. Now, these are holding REITs. These are actual, companies and real estate investment trusts, some closer to really to a stock. They're not investing in, residential housing. They do have different things out there, but all types of stuff, commercial properties, hospital REITs, apartment REITs. And you can see we had a big correction. It's bounced back a little bit, but the longer term outlook isn't very hot. So I think I'll wrap it up here. I think I've made my point. I've gone over what I believe to be an all-inclusive, just run through of all the different asset classes, all the places to make money out there. And again, that encompasses stocks. And as I showed you with the S&P falling and the way it fell, if you look at 2007 to the 2009 lows, everything fell. You might say, well, Randy, let's look at defensive issues. And again, go back to the previous bear market. You'll see utilities, although they've been catching a bid recently during the last bear market, everything fell. And there it is, there's utilities. And that's what happens if we are about to enter a new bear market. And more so, again, it comes back to that unwinding of the credit bubble. And when that money starts coming out of the market, everything's going to drop. There will be opportunities. I don't want to leave this. I want to leave this on a positive note. I have to dig a little harder. There are thousands of stocks out there. So what I do is I use a top-down approach. I will look for the most bullish sectors out there, drill down within those sectors, and try to find the most bullish individual stocks to see if we can start adding some long exposure. I prefer at most points in time to run a long short portfolio. At times I may be mostly in cash, but I like a balance of long and short trade ideas. And we do have that now. Keep in mind, we have the TLT and GLD, and I'll do an update on all of those soon. But hopefully, again, I wanted to get this out there now and just let you know that, over the next couple weeks here, we'll get back online. The site will be running fine. I'll have those issues behind me, get the new support center rolled out, and I'll be able to really spend more time answering questions in detail like I like to. I don't like to throw out quick answers. A lot of the questions I get put to me are not black and white. So my answers, my replies usually take quite a bit of time for me to compose, and I want to keep it that way. All right, we'll wrap it up here, guys. And again, I will follow up with updates on the broad market, especially if anything happens tomorrow. Worth noting. And I'll try to touch on the trade ideas as well. I know I've gotten some questions on gold, GDX lately. I'll talk on treasuries, but I do still like treasuries right now. I think the charts look good. Gold's hanging in there. Gold, and again, I don't want to get off topic. I'll get to it soon. So all the trade ideas that are on the site now, we'll leave them as is, and I'll try to get some new ones out for you as soon as possible. This has been Randy Finney with the right side of the chart. I hope you enjoyed it.